10, 9. We have ignition sequence start. The engines are on. 4, 3, 2, 1, 0.
More than a decade ago, a young American man recently laid off and with a baby and wife to look after took an audacious step. He founded a new finance company in the middle of the worst banking crisis since the Great Depression. Welcome to Constable Confidential. I'm Simon Constable. The man in question is Keith McCullough, CEO of Hedgeye, and he joins us now to talk about his new book, Master the Market, and the things he went through to get the company great. And indeed, it is great. Keith, thank you very much for being here.
Simon, always a pleasure to talk with you. Thanks for making some time.
Well, this has been a lot of work for you, not just in writing the book, but going through the entire financial system and working through it and having setbacks. It is true that you basically were audacious back in the middle of the financial crisis. Tell me about what happened step by step. And I understand first you were laid off after buying some new shoes.
Yeah, well, I was properly fired in November. Not that I'd remember the date or hold any chip on my shoulder, but November the 2nd of 2007, and my son was going to be born on November the 7th. So it was a very formative part of my life, as you know. Like, I was just initially married and about to become a father and all that. So I set out on my own, and that's in and of itself, it's an endeavor. There are a lot of risks associated with that. I couldn't have imagined how '08 was going to play out play by play, but for me, I was in it, and I'd already made the decision to go it alone and start my own firm. And as the year progressed, it just became increasingly obvious to me that the mission, to provide transparency, accountability, trust to the people, so to speak, and that's who I spoke to initially, or at least tried to convey, the message that markets can crash from oversold levels, and you can lose a lot of money. And that ended up playing out, and I don't take a victory lap in it playing out. I think more so for me to have ventured into the wild, so to speak, and to have survived '08 with my at least some of my hard-earned capital intact, because it could have gone quite a different way.
It could have gone. It did for a lot of people. A lot of people's careers ended then. A lot of people said, "Well, no, I'm not doing this anymore." People I went to business school with thought, well, this is enough. I'm not going back to that. I need to have a job that doesn't have this sort of activity in it. But you ran towards the flames, right? As the flames were burning down the business, not your business I'm talking about, but the entire financial business, and you ran towards it and said, no, I'm going to be in here. What was that makes you different from many people? What's the magic? If I wanted that magic, and I don't know that I do, but if I wanted it, and I'm sure people watching or listening will want that, what is it?
Well, maybe I just thought I had nothing to lose, right? I'd already been fired once. I could just get fired twice, within a year, and that would be the end of the career. And really, that's not how I thought about it. The way that I thought about it was, I never want to work for anyone else ever again. I want the game to begin and end on my terms. I want to build it my way, without any interference, and I want to do it an entirely different way. And it was not a difficult path to see. I know it's a hard path for people to take, and there's a difference. It's not hard to see. I mean, it's not hard to see the path against the conflicted, as I like to say, the conflicted and constrained old Wall Street. That's a very obvious path. Many people see it, but to take it, you have to forego a lot of compensation. Right. So and it's not like I wasn't getting offers to go, do my job at another hedge fund. That's what happens typically, is you get gassed from one place and you just go park your butt on another desk and do it at another place. But I just wasn't willing to do that. And I thought that, if I could just stay on that path, there are way more people that understand that path is there. And I just needed to stay steady. I knew it'd take a lot of heat from, the old wall itself. I mean, obviously you're challenging their compensation schemes. So that's what it was. I mean, to me, it was not a difficult thing to see and to see through.
So basically, you can tell anyone when the next crash comes, if they want to stay in the business, they should, and just keep going. When you're in a hole, stop digging, keep walking when you're going through hell.
Yes.
So you also write in the book about another experience where you were away at a retreat, and you had a few beers or something like that was heavy on you, and you wake up to find everything's going wrong with a position you have. Can you explain that from the beginning? Because that was very interesting to me, because again, that would have been the end for some people. Say, well, no, this isn't for me. I can't do it. I can't deal with the stress of this, et cetera, et cetera, et cetera.
Yeah, that was a close call. That was almost the first beginning of the end for me. That was as a young portfolio manager, analyst slash portfolio manager at a firm called Dawson Herman. I was at Bandon Dunes, right, and we were at one of these typical events where the bankers and the sell side would host you. You golf, you have dinner, you talk about ideas. You have some corporate executives in the mix and all that fun stuff. So we did have a fun night. There's no doubt about it. But I did not have a good morning because it's on the West Coast, and I wasn't awake yet. But my phone just kept ringing and ringing, and that's back when you didn't have cell phones. And it turned out it was John Dawson, my boss. I had a short position in Reebok, the shoe company, and they were getting taken out by Adidas, and or as the Germans would say, Adidas, and that was
that's what I grew
adios.
up with, Adidas. Yes, absolutely. So we got an even bigger audience now. Yes, Adidas and Adidas. So, but that must have been. I mean, that would have been a big shock for you, right? Big shock.
Oh yeah. Yeah, I mean, when a stock is going X double-digit % against you and you can't change it, you can't add to the position, you're just completely going to lose the firm a lot of money in that case. I was fortunate. I mean, I was fortunate to play for John Dawson and Russell Herman and that team because they believed in me, and that was, the company got taken out. Unless I had inside information, I was not going to know that. There are plenty of things that I built around my risk management process after that, because in hindsight, like when I think about my price volume volatility model, which I go through in the book, I mean, if I went back and reviewed the tapes, and clearly somebody knew something in Reebok, and that's when the price and the volume are going up at the same time on nothing fundamental. In some cases, in that case, when the market was going down. So I could have and I should have known that somebody thought they knew something, and I didn't. So that was like most mistakes I've made, Simon. I'd say actually the entirety of my process is a summary of my mistakes, like learning what not to do, learning what works, doing more of what works, cutting your losses, riding your winners. That moment in time was a very valuable education, as most mistakes are.
Now that's a mistake that a lot of people would have been floored by. They would have just been on the floor and saying, I can't do this. Again, what's the magic that had you saying, well, that's just me falling off a bike? Now, I've fallen off a bicycle more times than I can remember, and probably more blood that I can remember when I was a child. But what is it? Because a lot of people will just walk away from that, especially a big thing like that.
Well, I think, in our business, actually, you're quite right. In particular, when people move to the buy side, or when you become an analyst working, on the buy side, or eventually become a portfolio manager, a lot of people in our business are very intellectually competent, right? Very high SAT scores, accomplish, very rarely get a test wrong like that. And when they get something wrong entirely, like to your point, it shakes them to the core. Whereas me, I left home when I was 16 to play hockey. I got two complete raccoon eyes, like completely almost punched out in my first hockey fight. I was on my own for a long time with a lot of people betting against me. So I think in a way, me having the lowest SAT score at Yale, for example, and having had that kind of battle-tested life, that's who I am. And, for better or worse, some people love it, some people hate it, but that's who I am. And that definitely has helped me many times, because I've screwed up almost as many times as somebody can publicly at this point. I'm 15 years, building Hedgeye, and I have more tweets than I'd like to admit. So people know, and I kind of, in a perverse way, like being, like being the player that people are betting against. And I certainly don't bet against. I never actually bet against myself, and that's just a thing.
No, that's great. And the little tangent here, if some people who left school at 16 and had lots of failures are thinking about going to Wall Street and working on Wall Street, would you encourage them to do it? Because it looks from the outside. Now, I worked on Wall Street, and I'm talking about very much before I worked there. But a lot of people will look at it and say, well, okay, you've got to have had, top scores in everything, and you've got to be from this sort of family and been to this sort of school, and et cetera, et cetera. Should they just ignore that and follow your footsteps and say, well, Keith McCullough did this, I'm going to follow the same path?
100%. I mean, most of the successful people that I've worked with, or now currently work alongside, I mean, the life path and the journeys that people have been on of successful people on Wall Street are very broad. And what you find is it's more their EQ as opposed to their IQ. Obviously, everyone in this business is
EQ. That's emotional intelligence, right? Emotional quotient.
Exactly.
Yeah.
Yeah. Can you handle adversity? Can you keep these two things in between your can you keep two opposing thoughts in your head and not let the one thing that feeds the wrong side dominate? I mean, it's a thing, and it's a hard thing to really put your finger on until you work alongside somebody who's confident but not arrogant. They're constantly learning, and anybody could do that. I mean, I believe in having teammates that can really do that.
Well, that is unusual from many people's experience when they've gone to Wall Street. The investing business, and this gets me to the next question. The investing business has changed, and can you explain what's changed? Because you write about that in the book. It's changed, and what's changed for you, and how has that been better for you, worse for you, et cetera, et cetera?
Well, the biggest change is the impact of what I call the machine and the flows of the machine. So the bubble that became passive index funds and how they perpetuate those flows, and now how we have super short-term options perpetuating those flows at a faster and a faster and a faster pace. So you get the index weights, you have 401k flows, target date fund flows. The whole thing, we partnered with a company called Tier 1 Alpha where we show this visually every day. That was never really a part of the picture when I started. Like when I got that phone call at Band & Dunes, we were trading on the phone. You'd sometimes have two phones. We're block trading. It was basically game theory, trying to figure out, okay, when does Greenlight Capital have the information before we think we do? Who's got the position in it? Who's going to sell it to us? That's a totally different game than what we have right now. It's not to say that the flows don't eventually find the fundamentals, but that's why I say the game has changed to a quantamental game, where if you can't quantify where that flow is coming from and what the causal factors are to affect what we also call the factor exposures inside of the flow, like what country, what sector, what asset class, then you're really playing blind, or at least with one hand tied behind your back. And when you play against somebody like me, who's been beat up in plenty of hockey fights, as I pointed out earlier on, you don't want to fight me with one hand behind your back. I mean, it's something that I think that's a lot of people still struggle with because it's different. But you can clearly see the differentiated returns, in particular amongst hedge fund managers, on those who have embraced the new reality versus those who are still stuck in their old reality.
And embracing the new reality is something every generation has to come along with, and that sort of running towards the fire. It's important, I think, that we talk about the 4-quadrant system, which you use. It's deceptively simple, but it has a massive foundation. Can you explain in the simplest terms possible so people who've never heard of it before can understand, and what you've gotten out of that, perhaps?
Yeah, and it's not ironic that you say it or ask it that way, because it's simplifying the complex that I'm trying to do here. I'm not trying to say that the world is simple or that it's easy to solve for all these factor exposures and causal factors that drive them. But if we take a 2x2 model, we have two factors, growth and inflation. The goal is to figure out where is the rate of change. Is it accelerating or decelerating in those two factors? So again, is it getting better or is it getting worse? Not is it good, is it bad, does it feel this way? There's none of that. It's all math. So again, we have quad 1, 2, 3, and 4. Quad 1, when you take growth with slowing inflation, that's Goldilocks. Quad 2, when you have both growth and inflation accelerating at the same time, that's quad 2. That's very typical of an environment where everything's going up, including interest rates and Fed rate hikes. Then you get quad 3, which is stagflation, the prices of things, which we think we have right now in the fourth quarter in the USA. The prices of things are going up and real consumption growth is going down. And then, of course, you have the real one to risk manage, which is quad 4. So quad 4, if you were to have, Darth Vader winning, that would be in quad 4. That's the only quad where something like large cap tech and or growth investing overall doesn't work. That's when growth and inflation are slowing at the same time. The economy sometimes is slowing into a recession. We've seen that multiple times in my career, but not all the time.
One of the things I've got to ask you, which was related to that, in 2022, in the middle of 2022, I was asked by Time magazine to write about the imminent recession that was coming. And I, as usual, I dived into some data points and I couldn't find anything that was looking like a recession. And I then called some business people I knew and asked them how they were doing. They're saying, oh no, we're being offered multi-year contracts at the moment. And so after that, I wrote, there's no recession. There are sectors that weren't doing well. And yet Wall Street, much of Wall Street, kept saying, oh, there's a recession. It's imminent. I was like, well, it's imminent. I'm still waiting for it. And got my ticket here. Well, no, what do you think of that? I mean, isn't that just a mass failure of groupthink? What's going on there? I know it's a tough question because I'm puzzled by it too. And I have less data than anyone I know who writes about this sort of stuff.
Well, at least you're acknowledging a part of that. I think you're understating your capability, but it's behavior, right? I mean, so if you take a step back, the market did crash in 2022, and the economic cycle peaked in what I called quad 2 in 2021. So after the crash came, that consensus of, oh, we're going into a recession. Yeah. Where all you really had to have was the rate of change slowdown, again, in growth and inflation from the cycle peak of 2021. Now, to your point, inside of this slowdown, there was rolling recessions, as my friend Lizanne Saunders likes to call it, or call them. Like industrial production growth was negative on a year-over-year basis. Manufacturing was negative on a year-over-year basis. Small business earnings were not even in a recession; they were in a depression. So we had a lot going on, but you definitely didn't have a mainline recession reported. And the biggest reason for that is because government spending went roof. It went to the highest levels of debt and deficit spending in human history. And that, it equated to a third of the jobs gains. It equated to a massive amount of GDP. So you didn't have a mainline reported recession, but you had a lot of, regression and a lot of, collapses inside of that, of course, depending on what stock or sector that you owned.
Yeah, I knew about the sectoral problems, but when it all got sort of grouped together as sort of this is going to really destroy everything, and I think it didn't do the media a lot of good. I think I did Time a lot of good by saying no, it isn't, despite being told I was wrong by a number of people, not at Time. What's the difference between a great investor and a mediocre investor? So imagine me. Well, you don't have to imagine mediocre investor Simon Constable. Okay, the difference between you, who is not a mediocre investor, and me. What is it? Because there's a lot of people like me out there who know how to put money in the S&P 500 and leave it there.
Well, first of all, I don't know if I'd characterize myself as great at anything, but I would say I am a very good risk manager. And I think that there's a big difference between the people that are mediocre or no good at this are people that lose a lot of money. Let's just start with that. So identifiably, I think there's an opportunity to recast this as opposed to, I'm not Warren Buffett. I think everybody obviously knows that. But I can help risk manage a lot of the dogma that's out there and the cycle itself so that you're not in a position where you're losing when everybody else does. I think that makes people mediocre to bad at the job. If you just make money when everybody else does and lose money when everybody else does, that's called beta. So to be really good at this, you have to generate alpha. And for me, my definition has been never miss a market cycle top, never miss calling and or positioning for a stock market crash, a commodities crash, whatever the crash is that we're looking at. We're currently short Turkish stocks, which are crashing, Danish stocks, which are crashing. Again, to me, that's my, and I don't really care to be known as great. I care to be very good at that every single day. And when I'm not, to be learning on how to fix it, because risk management is where it's at for me in defining that.
Now, one of the things you wrote about in your book, which is a fascinating book because it's a as we spoke about earlier, it's more than just how to make money. It's about your life and how you got to where you are now. Is the amount of time you have spent every day on looking at markets and studying them and studying data, et cetera, et cetera, et cetera. That's not something for the faint of heart, because a lot of those things are really hard to learn. The first book I read in America when I came in 1992 was the Handbook of Fixed Income Securities by Bobosi, which was mind-bending at the time for me, because it was the first one I'd ever read. But is that what you would expect young people to have to do, is to basically just work and work and work and study and study and study?
I mean, if you want to get good at this, or you want to get better than bad at this to start, because you're definitely not going to be good at it until you make enough mistakes to get good at it. I think you need to do the job. Like, I think you need to be in the seat. I think you need to put in the time, and most importantly, put in the reps. So start a paper trading account, whatever you need to do. Use live ammo, which I had basically none when I came to Wall Street. I had nothing but student loans. But again, now I do, and I learn every day with that. So, every single day, battle test your process, do it. For me, I'm not smart enough to not work that hard. So, but I can outwork people. So every day it's at 4:30 in the morning. I get up, I do my job. There's a very specific process to that, right up until the macro show, which is at 9 o'clock. And then, of course, as soon as that's over, then I start to do the reps with real capital. And that's the job. I mean, you're either in it to win it or you're not. Now, the alternative is, of course, to want to get rich quick scheme, own something you can hodl and not do any work at all, but believe. Like, anybody can believe anything. Right? I mean, I'm not saying that the things that people have believed, which are fully loaded with frauds and laser eyes in some cases, aren't things that they could believe for some period of time. For a long period of time, the media thought that Sam Bankman-Fried was like was the second coming of Jesus Christ, which is very serious to me because I'm Catholic. But he wasn't. He was a fraud, right? So I think, again, my answer, and I was taught this, and I'm very fortunate, Simon, to have my parents. My dad. That guy's a grinder. Like that, he's a firefighter of 38 years. He'd come off the night shift at 6 in the morning, change his clothes, go bang nails at the building houses, and do it again and again and again to provide for our family. And that kind of work ethic and getting up and doing the job, whatever that freaking job is, and I had a lot of. He gave me all the worst jobs if I was on the construction site with him. I think that's something that you learn by doing.
Yeah. You learn by doing, and I think that's probably a great place to leave this. Now, the book is available, I understand, on the Hedgeye website. Is that correct?
That's right.
To people to get for free, and I will also put it in the show notes for this podcast and video that we're going to put out shortly. Thank you very much, Keith McCullough, CEO of Hedgeye. Real pleasure.
Thank you, Simon. I appreciate it.
We have cleared the tower.
Roger. Howdy here, Houston. Loud and clear. Mark, North 1 Bravo, Apollo 8. North 1B. Apollo 8, you're looking good. Roger.
An S1C, the first stage cut off. S2 has ignited, we can confirm. And the thrust looks good. All engines, all sources show the second stage is burning perfectly. 2 minutes, 51 seconds into the mission. And at 3 minutes into the flight, the range safety console has been released at the Cape. 3 minutes into the flight, we're 50 miles high, about 10 miles downrange.